Welcome to Limiting Your Exposure, Claims Against Accountants webinar. I'm going to welcome today's moderator into the conversation. Welcome, Katie Waller.
Thanks, Gabriel. Welcome everyone to today's sponsored webinar, Limiting Your Exposure, Claims Against Accountants, sponsored by QBE and Fenton Green and hosted by CPA Australia. My name is Katie Waller and I'm Head of Public Practice and SME at CPA Australia, part of our Professional Standards and Business Support unit. We'd like to welcome people who are joining us today. We have people from all over the country, so thank you for joining us in our different time zones. I'd like to take a moment to acknowledge the traditional owners from around Australia and pay our respects to elders, past, present and emerging. I'd like to extend this acknowledgement to all Aboriginal and Torres Strait Islander people who may be joining us today. Now it's my pleasure to hand over to our presenters, Frank Hinopoulos and Bridget Wall, to present our webinar. Thank you.
Thanks, Katie. Hi, everyone. I'm Bridget Wall. I'm a partner at Hall & Wilcox Lawyers in Brisbane. I do professional indemnity and general insurance litigation. I've got with me today also Frank Hinopoulos, who's a tax partner in our Melbourne office, also from Hall & Wilcox Lawyers. Here's our bios there. If you ever want to get in touch, please do. The topics that we're going to be discussing today are, we're going to go through an introduction to the duties that you owe as an accountant. We'll talk through some examples of the types of claims that we're seeing and the standards of care that's owed, scope and limits of your professional indemnity insurance policy, and for that we'll be looking at the QBE insurance policy that's arranged through Fenton Green. And then Frank also will take you through sort of identifying the key risks of tax risk for your business, where potential claims may arise and how to de-risk your business, as well as looking at that issue of determining the scope of your tax expertise and when a input from a tax specialist may be required. So to kick off, what are your duties as an accountant? So you as an accountant, you owe a number of duties to your clients as well as to third parties. They can be grouped into these four areas: contractual, common law duties, statutory duties, and the professional and ethical requirements under the Accounting Professional and Ethical Standards Board. For today's presentation, I'm only going to be really focusing on the duties of common law and the contractual duties, just for the interest of time, and it's probably a whole separate webinar. It could be done on the statutory duties. It's important to know that all four are owed concurrently. The common law duties and the contractual duties will be relatively similar. You can think of it that way. Both of them will likely exist at the same time when dealing with duties owed to a client. However, in respect to duties that you owe to, say, a third party who isn't your client, those duties will be solely owed at common law, given there's no contractual retainer between yourself and the third party. As I said, there's also statutory duties. They're going to be found under a number of pieces of legislation, including the Corporations Act, the Tax Agents Services Act, and the Australian Consumer Law, which is found under the Consumer and Competition Act. Under the ACL, it's important to know that, for example, and this, we're seeing some claims come out of this, is that accountants may be liable, for example, for providing financial statements which are misleading or deceptive. So, for example, an accountant had a claim made against them in relation to the projections of the outgoings of a business for sale. The accountant needed to show that he had made a proper professional assessment of the profitability of the business based upon historical factors and industrial norms. So that's something to keep in mind, that that's how those ACL claims under Section 18 arise, and you can't contract out of Section 18 of the ACL. Finally, as I said, there's those professional and ethical requirements under the APESB. It's based on the 5 fundamental principles of integrity, objectivity, professional competence, due care, confidentiality, and professional behaviour. I expect all of you have, but if you haven't read the professional requirements issued by the board, I recommend you do. So today, as I said, I'm just going to be focusing on the contractual duties and the common law duties, because that feeds into this idea around staying within your lane. So first of all, the contractual duties. A contract can be the nature and extent of an accountant's contractual duty to a client. It will depend on the instructions given by the client. However, as a starting point, any contract between the accountant and the client carries with it a term implied by law that you as the accountant will exercise reasonable care and skill. Ideally, the contractual duties will be supported by a written document. You'll have a written retainer with the client. However, a contract can also be verbal. It doesn't have to be a formal contract. It can also just be an email to the client. When thinking about your contractual duties owed, the scope of the retainer is really important. So factors such as who are you acting for, identifying who the client is, what services are you authorised to provide, what are you not engaged to do, what is outside of your scope. You want to avoid what's known as scope creep, and that's why there's a real benefit to having a written retainer. As an accountant, you need to be careful if you assume an additional duty, either by express agreement in the retainer or by holding yourself out as having expertise in the particular field which is sought by the client, because this will create a special duty and you'll be held to that high standard. So for example, if you hold yourself out to be particularly skilled at forensic accounting, you'll be held to that standard, and that will be the test if a claim is made against you. Now, I've mentioned on the slide there that, and this isn't a duty, but I wanted to raise it now as it touches on what should be included in your contractual retainer and your agreement with the client. It's a professional standards scheme. So it provides a mechanism to limit your liability in circumstances where you've complied with the requirements to be covered under the scheme. So its aim is to improve professional standards across the industry so that consumers are protected. It lifts the standards, and it requires you to do a number of things, including having appropriate professional indemnity insurance. You also need to participate in CPDs like this, abide by all laws and regulations, as well as participate in audit to monitor compliance. One thing is you have to advertise and note on documentation that your liability is limited due to the scheme. The cap on liability is going to be reflective of the fees billed in the transaction, as well as the type of services that were provided. So for example, for auditing services, if the highest fee is less than $100,000, the way that the scheme works is that it caps, or it seeks to cap your liability at $2 million. It won't limit liability though for claims where there's a breach of trust or fraud, dishonesty, as well as personal injury. But I mean, that's probably going to be unlikely to, personal injury at least, unlikely to arise in the accounting space. Your duties at common law. It's within the accountant's area of responsibility, so an accountant must exercise reasonable care and skill in the performance of all of their duties. As I said previously, that duty is owed both to clients and third parties. The duty that's owed to third parties will be subject to the specific circumstances. The standard of care required of an accountant is the standard that is widely accepted in Australia by PR professional opinion as competent professional practice. So whether an accountant has exercised reasonable care and skill is established by a comparison with what a proficient practitioner would have done in such circumstances. And as I said before, an accountant who claims to have that higher or a specialised skill or expertise will have a higher standard of care. In relation to duties owed to third parties, it arises in circumstances where the accountant performs work for the client and the accountant knows or ought to know that the work is liable to be relied upon by a third party, or that the third party may suffer financial loss if the work in question is done negligently. And so you, it can be quite daunting since a wide variety of people, you know, for example, for a auditor, a wide variety of people may have a legitimate interest in the accounts of a company. You may also owe duties at fiduciary duties as an accountant to your clients. Duties, and that essentially means you have a duty to act with the highest degree of honesty and loyalty towards another person and in the best interests of the other person. So what type of claims that we frequently see against accountants? So I've grouped them there on the slide. One that we commonly see is outside the practitioner's expertise. And this is about, you know, obviously the idea of staying within your lane. We see this, for example, when accountants stray into the area of financial advice or legal advice. There was a case in 2001 called Page and FPI Limited, and the defendant there gave the plaintiffs advice about management of their incomes and investment of their assets. Although that advice involved matters that were outside the accountant's expertise, the plaintiffs did accept that advice. They made those investments, the investments failed, and the plaintiffs lost a considerable amount of money. They then commenced proceedings against the accountant, claiming breach of contract as well as damages for negligent advice and breaches of fiduciary duty. The Supreme Court held that the defendant owed the plaintiffs a duty of care, even though he had not been actually specifically retained for the purposes of advising on the investments in question. More particularly, the court also held that it did not matter that the plaintiffs had not expressly requested the advice from the accountant. The fact is that because it was clear that the accountant had encouraged them to act upon the advice which he gave, and they suffered loss as a result of that, the accountant was found liable. Another example, as I've just said, is that providing financial advice and investment advice when not properly qualified. We acted for QBE in relation to, for example, multiple claims brought against a accounting firm where one of the partners was arguably providing financial advice without any type of AFSL limited license or any license at all. That advice was specific to each individual client. It considered their financial circumstances. It considered different types of financial products available and also specific, for example, shares, ASX listed shares, and then the accountant made recommendations to the clients about which ones they should purchase. That was found to be financial advice, and not only was that outside the scope of the accountant's expertise and their license, but it was also outside the scope of the policy, the insurance policy, which I'll touch on again. I'll touch on soon once we get to that part of the presentation. There's also, you know, just quite commonly just negligent advice or incorrect advice. The advice is just wrong. It's within their scope. The accountant can provide it, but it was just incorrect. There was a decision in the New South Wales Court of Appeal in 2005 where the accounting firm, they were appointed as auditors of a group of companies. The auditor's report was prepared using the recognition of revenue or earned value method of accounting under the relevant accounting standard, AASB 1009. The auditors also gave consent under the Corps Act for that report to be included in the company's shareholder prospectus. So then in the subsequent financial year, the auditors again prepared a report using the recognition of revenue method. In particular, that method was applied to a contract that the group of companies had obtained overseas in Russia. That same year that the report was prepared, the group of companies showed significant consolidated trading losses. A liquidator was appointed and proceedings were commenced by the creditors against the auditors. At issue was whether the auditor's interpretation of the accounting standard was reasonable and appropriate in the circumstances. The Court of Appeal held that it was so in relation to the initial report, but not in relation to the subsequent report that dealt with the Russian contract. So as such, the auditors were liable for the trading losses that were incurred as a consequence of the inclusion in the report of the Russian contract profits. Another area where we're seeing claims, and this touches on in terms of saying or going outside your expertise, is failure to properly assess capital gains tax liabilities, stamp duties liabilities, or state payroll liabilities. So these are obviously all state and territory based tax laws. Accountants need to be careful when giving advice around this, not only first, that it's correct, but more importantly, that doesn't stray into unqualified legal advice. So if you're going to give general advice about what CGT liabilities are, whether stamp duty would be payable if there was a transfer, arguably that's relatively straightforward, particularly, what is CGT liabilities. But if it requires you to interpret a document, its legal advice, or interpret a document from the client, its legal advice. One example, we have a matter where the accountant and the lawyer were both engaged by the client in relation to a restructure of trusts and change of control. The trusts owned a number of pieces of property. The restructure brought up an issue in relation to stamp duty. The lawyer said, and put in writing, we're actually not engaged to do that. Our engagement is limited to just preparing or preparation of the documentation around the transfer. The lawyer said to the accountant, you're going to be dealing with stamp duty. We're having no involvement in this. The accountant, though, was not qualified to consider the stamp duty implications. But the fact is they actually did consider it in the sense that they told the client, there's no stamp duty issues here, you'll be able to get an exemption. And they considered it was going to be fine. A couple of years later, it wasn't fine. The Commissioner of Declarations wrote to the clients and said, you've got a stamp duty liability that you have to pay. And so in that example, it's important to think about, the question is, are you as an accountant determining specific rights or obligations under a particular set of facts? If the advice that you're giving or attempting to give involves reason and consideration of the application of the law, you might be providing legal advice, and that's when you need to stop and pause and think, okay, I need to get my client, or get my client to engage with a lawyer and tell them that I can't provide this advice. They need to get that advice from a legal professional. We also are seeing a breach of trust fiduciary duties. We don't commonly see these separately. They, in terms of if there's already a breach of contract claim and a common law duty claim, then a breach of fiduciary duty or breach of trust is commonly tacked on. So I won't talk about that one too much. The final one is disciplinary proceedings or disciplinary complaints to ASIC, the ATO, Tax Practitioners Board. One area where we're seeing is, and I think this is consistent with also what CPA Australia has said, that they're commonly seeing complaints around, is conflicts of interest. And this can happen a lot, obviously, in the family dispute space. It goes back to, I think, in terms of how to manage it, it goes back to, who is the client issue? Have you identified who the client is? Who's going to be on the other side of the matter if it is a contentious matter? Is there a conflict there? It's also important to recognise that conflicts are something which are continuing. It's not something that you can just do at the start of a matter when you first seek to be engaged, do a conflict search, and then not turn your mind to it at all throughout the life of the matter, particularly if circumstances change or there's a development. It should be turning your mind to whether there's a conflict of interest should be a continuing issue or a continuing matter that you think about throughout the life of a matter. So putting some of those thoughts together, we've put out sort of 9 steps or 9 items there about what you can do to try and avoid claims and breaches. As I said, the retainer should be in writing, clearly outline the scope of the retainer from the outset before you start to perform work. Make sure there are clear boundaries for what advice you will and won't be providing. For example, if you're, the example that I gave around the stamp duty issue, if you're working on a transaction that there may be those stamp duty or CGT liabilities and legal advice is necessary, that should be specified in the retainer as an exclusion from the services that you will be providing to the client. Good file management is critical. Keep records of any advice that you give to the client. In writing is obviously best, but if you give verbal advice to a client, then that should be recorded in a file note, a contemporaneous file note ideally. Whether we can successfully defend a claim against an accountant is commonly comes down to how well organised their file is, whether there's evidence of certain advice being provided to the client, for example. Take care to fully understand the needs and businesses of your client. What's the problem that they actually need assistance with? And then that can help you work out if the issue is complex enough that you need to, first of all, whether you have the expertise to do it, but then also whether if part of it is potentially complex enough that you need to get specialist advice. Seek clarification from your client if they give you vague or ambiguous instructions. As I said, stay within the scope of your retainer. Avoid scope creep. If the engagement changes, do up a new retainer to ensure that it reflects the updated state of affairs. Consider having your advice sense checked, particularly by another colleague in your team. When providing conceptual high-level advice, it's worthwhile providing a rider that it's subject to, if there are limitations, subject to limitations and what those limitations are. That can also assist you if that advice is going to be disseminated to other third parties or others who aren't your client. Similarly, when publishing a document, consider including a clause disclaiming liability, as I said, for third parties to rely upon it. And as I said, if you're going to obtain outside specialist advice, make sure they have the relevant expertise. My understanding is that CPA Australia can assist in identifying necessary experts in the specialist field if necessary. It's important to know you don't have a general duty to always refer a client to a specialist. It depends on the advice they're seeking, the specific client, what your expertise are, what your license allows you to do, and the scope of the retainer. So touching on just briefly the professional indemnity insurance coverage. So my understanding, obviously, Fenton Green partners up with QBE and provides professional indemnity coverage. The policy wording is a QBE policy, and so the comments that I've made on this slide are specifically geared towards the QBE policy. I appreciate that some of you might have professional indemnity insurance with a different insurer. It's always best to check what the wording of your professional indemnity policy says, particularly around some of these points that I've raised here. First, the insuring clause. Essentially, its cover will only kick in if the activities which you're providing fall within the definition of your profession. The QBE policy defines them to include, and this isn't an exhausted list, but it's accounting, bookkeeping, audit or valuation of any entity, taxation services, any appointments held by you when you're acting as a trustee, receiver, manager, liquidator. If you're doing an activity which is outside that definition or outside the CPA Australia bylaws about what the activities of an accountant are, you might not be covered and you should probably stop doing those activities. I'll jump ahead to fraud and dishonesty. There's an exclusion for fraud and dishonesty or any willful breach by you of any legislation. There's a limited right back in the QBE policy, which seeks to provide cover to innocent partners and employees of an accounting practice, but there's still no cover provided to the individual who engages in fraud and dishonesty or willful breach of legislation. One exclusion that we see that comes up quite regularly is the financial advice exclusion. It's really common and it can be difficult to disentangle taxation advice given in the ordinary course of business and financial advice. One way I look at it is that if that advice is directed towards or recommending a client purchase a specific financial product, it's based on the client's specific circumstances, and then you make a recommendation as to what financial product they should purchase, that will likely fall foul of the exclusion. This is compared to, say, just a general class of product advice. If the accountant has a limited AFSL, they can give some limited advice subject to the wording of the policy. Now, finally, to check before I hand over to Frank, to check that you've all been listening, we have a poll question. It's quiz time. So the question there, which I'd like you all to be able to see if you can answer, and there should be a polling that's come up, is a polling box that's come up on your right-hand side, is in Australia, does the scope of an accountant's duty to their client include a general duty to refer a client to a specialist for advice? So the answers to choose from are yes, an accountant has a general duty to refer a client to a specialist for advice and is implied into the retainer, whether written or not. No, there is no general duty. Or finally, no, there is not an overriding general duty, but it depends upon the terms of the retainer as well as the circumstances of the case, including the nature of the transaction, the client's needs, business experience, or complexity. So there's your 3 answers to choose from. My understanding is the poll is open, so you should be able to pick from whether it's yes, there is a duty, no, there's not, or no, there's not a general duty, but it depends. So I'm seeing the responses come through, and pleasingly, it looks, maybe I'll give it a couple more seconds for everyone to put their answers through. Early signs are, though, that everyone has been listening to me and most of you are answering correctly. I think we've got 10 more seconds left and then we'll close off the poll. So the answer is no, there's not an overriding general duty, but it depends upon the terms of the retainer as well as the circumstances of the case, including the nature of the transaction or services, the client's needs, business experience, and complexity. So most of you got that right. So with that, I'm going to hand over to Frank now.
Excellent. Thank you very much, Bridget. That was a fabulous, a very hard act to follow, I must say. But no, it's great to be with you. Always great to be with a CPA audience filled with accountants, and terrific to be speaking with you this afternoon. So Bridget has already said that I'm a partner in the tax team, and my work really has two parts or components to it. One is giving advice, specialist advice at the front end, as we lawyers like to say, on transactions or on more complex and tricky tax issues. And the other bit of my practice is focused on ATO disputes and litigation. So that's all the way through an initial examination to taking matters to court, defending taxpayers against amended assessments issued by the Commissioner. So it is in that context that I'm going to be speaking today, and really outlining a couple of the areas where, in our experience and from our observation, we see some of the risks emerging. But before we get to some of that, I might just start with some general comments that really do pick up on a lot of the issues that Bridget has already mentioned. And hopefully the slides are changing there, Bridget. And it's on identifying key areas of risk. But anyhow, so I mean, I think it's not going to knock anybody off their chair if I say that tax is hard, bloody hard sometimes, and complex. And I think the longer I do it, and it's nearly 20 years that I've been practicing in tax, the longer I do it, the harder it seems to become. And every year it gets more complex. Every year you feel like the more you hang around, the less you know. So, I mean, it is a hard area to practice in. And what I see with clients is that the risk comes from two sources. The first source is complexity. You know, the law is hard. It's hard to interpret. To understand what the words in the legislation means, you oftentimes have to go and search a lot of other authorities to get the meaning of the law. And then even if you figure out what the law is, then you have to apply it to a particular set of facts and come to a conclusion. And if you're giving advice, you might have to give your advice to the standard of a reasonably arguable position. And there is complexity in the law, and tax is so broad and diverse, and there are so many issues that we can't be good at everything. You know, we can't be competent at everything. We are going to have blind spots in our knowledge and in our technical capability to sign things off. The other complexity comes from, I say this a lot because it's often when I come into the picture, but it can come about because of the materiality of a particular transaction. You might be doing something very, very simple, you know, something that you've done 10 times before for a client, like a trust resolution, for example, distributing a capital gain. But all of a sudden, you know, if you take your capital gain from 50,000 to, as we've had to assist with, $500 million because the client sold a portfolio of very valuable CBD real estate, then that's a slightly different risk proposition. You know, it's one thing to be doing a trust resolution for 50 grand. It's a different matter altogether to be doing a trust resolution for 500 million or 50 million or 5 million. And you know, your risk profile there and your level of paranoia as an advisor increases exponentially. So I think those are two key sources of your risk. There's that the complexity part, and then there's the materiality part. And I think it's really important for all of us as advisors, and whether you're an accountant assisting clients with compliance and advice, or whether you're a tax specialist like me, self-proclaimed or otherwise, you know, you have to know your strength, and you have to know your blind spots, and you have to have some self-awareness of that. And you know, I see the good accountants that I work with apply, you know, an initial diagnostic evaluation across those two standards. How complex is it? How material is it? Am I in my comfort zone or am I not? Having come to that point, in a broader sense, I think that good accountants have strategies to manage these issues and to effectively de-risk their practice. Now, this is where some of you might fall off your chair, sort of possibly laughing, but to say that we should hire additional staff to cover key gaps, I'm very well aware. 90% of my time I spend talking to accountants, and I'm very well aware of the resourcing constraints that most accountants firm have, not by choice, but because of demand and pressure in the market for talent in accounting and so on and so forth. But I think that's that dynamic playing out in accounting right now, where there is oftentimes some difficulty in getting staff. If you have staff, there is considerable difficulty in accelerating that learning curve and experience curve for your junior lawyers. And firms, particularly SME-focused firms, can be at different stages of their development, and can never sort of reach that point of nirvana where everybody is, where you have enough resources for every issue at the right time and everybody ticking along very, very well. There is, I think, that underlying system issue that every accounting practice needs to be aware of. The other issue, and there's an element of talking my book here, but it is important, I think, to build relationships with experts. And that's what I do. That's my entire business proposition. I mean, why I exist is to be an outsourced tax specialty function for predominantly accounting firms, but other professional advisors too, financial planners and sometimes international lawyers and so on and so forth. So if you do have that issue where the complexity is such that external advice or a second opinion may be necessary, or where the materiality of the issue is such that it may call for some external specialist advice, then that's why people like me exist. And oftentimes we do the same thing in our practice. There are some issues where the right advice for the client might be to seek a private binding ruling from the ATO, or maybe to even escalate the matter to QC sign-off, which you might do if there's a particularly controversial issue, and you want to get the equivalent of a sort of judicial attitude to a particular client's matter. Oftentimes it happens, sadly, and in the rest of our discussion, we'll be talking about the circumstances and the issues around which this may arise. But the work that your practice has done might be reviewed or examined by a revenue authority. That would be the ATO in the federal sphere, and one of the revenue authorities in the state taxes sphere. I mean, that's never a pleasant experience, obviously. Nobody wants to be the subject of an audit or an examination, but it does happen, and I think it will, in relation to some clients and some issues, start to happen more and more. And we'll explain the reasons why that'll be the case in a second. But if you are, as an advisor, in that scenario, I think one important practical thing to do is to work out and determine whether your insurer should be notified, and if so, when. And that may vary depending on the terms of different policies, but I generally find that good accountants take the approach that you can never communicate too much, and once an issue becomes evident, then it certainly should be ventilated with insurers to provide that degree of protection for the firm and for the practitioner. And also, there is an element where if you have given advice to a client and it's now become controversial and there's a regulator looking at it, I mean, in a sense, you can confront a conflict kind of scenario, because you may very well be marking your own homework or defending your own advice. So it is prudent and intelligent to pause and consider whether or not the client, not necessarily you, but whether the client should have some independent advice or some independent support in a scenario like that. Now, in terms of what are some particular issues that have become the focus of ATO attention in this instance, we'll start by looking at the federal area. But what are some of the areas that have become focus points for the ATO, particularly in the last 12 to 18 months? I'm sure there'll be many people on this call that will have clients in this category, but the ATO, not in the last 12 or 18 months, but for quite some time, has run a number of highly targeted, highly focused compliance programs, especially for clients in the high wealth segment. And the general definition of that tends to be the top 500 privately owned groups, and there will be a privately owned SME group focus in this presentation, but the top 500 privately owned groups who are established groups that command a significant asset base or have significant turnover in the order of 50 million plus. And then there is the next 5,000, and that is those entities that are not quite in the top 500 club, but in the ATO's view, getting there. And that's really where you see a lot of activity in that next 5,000 space, because that tends to be businesses that have grown very, very quickly, that have become complex, more complex in a quicker period of time than perhaps a more established business might be. And regrettably, a business that's gone through that high growth phase tends to be a business that has made more tax mistakes than you might find in another organisation with a more well-developed finance function or tax function. So the ATO has this specific compliance program on that segment of the market, and I think that's going to continue. Every indication is that will continue. And effectively what you have for clients that are in these kind of programs is not really a system of self-assessment. It's more of a system of full assessment. You're almost corresponding with the ATO in real time. Now, every time you have a review, the most important thing, and Bridget made this point in her presentation as well, with tax, with the law generally, it's not what you say is true, or it's not what you say the fact is, it's what you can prove. And the downfall in most ATO reviews, especially if they end up in an amended assessment, is necessarily not the practitioner having the wrong side of the legal argument or the wrong side of the technical argument, but just lacking the contemporaneous documentation to prove that the facts are as they say. And I mean, it's a difficult thing. I mean, there is some tolerance, especially for clients in the SME space, that you're not expected to document your corporate decision making to the same degree that you might have in a public company. You're not the board of BHP, you're a board of a family-owned business, but there is some recognition of that. But I mean, ultimately, if you're talking about key tax-sensitive decisions, it's pretty hard to try and defend a taxpayer in an audit when all you have to say is, well, it's all up here. Just can't work that way. So as Bridget has said, from a practitioner's point of view about recording your advice and recording your file notes and what you say to the client, also you need some discipline and some diligence around what sort of information base is being created around the client's decision making as well. And that's because that is going to be your potential saviour or your potential defence if you get into a heated audit type of scenario. I don't think this will come as any surprise to anybody, but in terms of some of the issues that are under examination quite often from the ATO in the capital gains tax area, the small business EGT concessions, I mean, that is almost made for audit, if I can put it that way. I mean, the law is actually complex. It's a small business concession, but actually the law itself is pretty hard. When you open up the legislation and read it, it's hard law to interpret it. There's nothing. Might be a small business thing, but there's nothing simple about it. The other reason is that it's very binary. I mean, you either use the concessions and pay very little tax, or the concessions don't apply and you pay a lot of tax. And oftentimes you're talking about millions and millions of dollars as a very binary outcome. So there's always enough in there for the ATO to have a good crack at it and to justify the time and resources of an audit. I mean, our general attitude towards the concessions now is to tell taxpayers to be almost audit ready in terms of giving their advice. Assume that it'll be looked at and assume you will be justifying why your position is reasonably arguable to the ATO, and approach it in that way. And you know, sort of again, going back to those initial risk indicators that I said at the start, this is one of those things. I mean, you might do your client's compliance for 20 years, and they'll lodge their returns for 20 years, and they'll do their resolutions for 20 years, but they might only sell their business once. And they probably will only sell their business once. So, it is at that point when you're dealing with something that is out of the ordinary that the complexity goes up and that materiality goes up. And, you have to go back and think about really whether you are in a comfort zone in terms of looking after that specific issue for the client. The capital revenue distinction, again, very, very germane fields for the ATO to commence examinations around that, because it's so arguable. I mean, these are the cases we do when we study tax at uni, and Whitford's Beach, it is something on revenue account or capital account, and there's no law in that. It just depends on the facts. And, if you take the same set of facts, two people look at them, and subjectively they come to do two different opinions about what those facts say and how the law should apply to them. So that is an issue where there is a constant flow of queries. The capital revenue distinction also becomes interesting, and in the sort of most recent context, we see a bit of this around crypto and cryptocurrency, and people who a couple of years ago were making squillions on bitcoins and crap coins and everything else, and all of a sudden the market fell out of that. It's funny how a bull market begets many capital account holders, and a bear market begets many revenue account holders. And if people start switching and chopping and changing, then they may very well put themselves on the ATO's radar. GST compliance is always going to be a focus of attention, and it is an area where there have been well publicised incidents and cases involving fraudulent activity that many taxpayers and even accountants have been caught up in inadvertently. And also the R&D tax concessions. Again, that is a bit of a chestnut issue, because again, there's a factual inquiry at the heart of all of that about whether or not an activity being carried on is truly experimental, as the R&D provisions might require. Picking up the pace a little bit now, but there have also been, and again, these aren't necessarily brand new things in the last 12 months, but there are a number of chestnut issues that have been constant sources of revenue attention in the state and territory taxes space. And as a general proposition, state revenue authorities have always been pretty hard-nosed, and they are pretty litigious. When you look at the reports, the tax reports that come out every month, there will be as many, if not more. Now, there will always usually be more cases that have been run by state revenue authorities in court than have been run by the ATO. So they're certainly not afraid of having a crack. The big issue, and I think what's going to be a big source of risk for accountants now, is payroll tax, which gets really complex because of, again, the rules. And with payroll tax, there is broadly harmonisation across jurisdictions, but that doesn't make the law easier to apply. And one of the key things that is problematic right now, and ever since I was at uni, we were talking about employer contractor distinction cases. We're still getting new cases all of the time that are flipping accepted authorities on their head, day in, day out, year in, year out. Thomas and Nas being recent examples of that, and then all of the court cases involving Uber drivers and delivery drivers and gig economy workers and so on and so forth. The other area that we often give advice, but sometimes deal with on the back end, is in specie distributions from trust, and especially the tricky rules that many jurisdictions have around that occurring for no consideration. And again, in the land tax area, arguments about primary production exemption, the primary place of residence exemption. The key common thread of all of these is that they are tax provisions, in this case, state tax provisions, that rely very heavily on factual questions. That they are not really questions of law, they are questions of fact. And like I say, you take a set of facts, you pick it apart, very easy to come to a different view on the same set of facts if you're a revenue authority, and very easy to do that if the facts are not supported by contemporaneous documentation. looking into our crystal ball a little bit, and what do we see as being some of the possible trouble spots going forward? Really, I feel like for the last 12 months, I've been talking about 100A even in my sleep. It has been the sort of hot issue in for SME and private market segments. I think it's real that the ATO's focus on trusts and private and family-owned group structures, it has now is almost a zenith. It has never been under more scrutiny than it is today. And with 100A, obviously, it's been a long, drawn-out process of the ATO formulating and releasing administrative guidance around how to deal with trust distributions and trust distributions to corporates that are retained in a trust environment, and how they can be compliant and when they might not be. In court decisions recently, and most notably in the Guardian AIT decision, which was effectively a 100A case, or was run as a 100A case. But in that particular decision, certainly the full federal court decided it could push the boat out a little bit on applying a Part 4A analysis to an arrangement like that. And the other issue that we hear about and we see emerging is around Section 99B, which is a provision around Australian residents being assessable on distributions from overseas or foreign resident trusts. But again, a little bit like 100A is, that's another provision that was, has been in the legislation for a long time, since the 70s, was there for a specific purpose to deal with particular avoidance behaviour occurring at the time it was introduced. But where the parameters of it, or at least the boundaries of it, are a little bit fuzzy. And we think about it as an issue that affects foreign trusts and Australian resident beneficiaries, but that's not necessarily clear. So I think that's the word on the street, or the buzz, is that that's what we're going to be hearing a bit more about from the ATO in the next 12 to 18 months, and we should be aware of that. Now, GST, in the most recent budget, the government said it was giving the ATO more money for GST compliance. I think what's really interesting there is that they said they were giving the government more money for GST compliance, giving the ATO more money for GST compliance. But when they put in an estimate of how much revenue they expect to make from this compliance activity, they expect to make as much non-GST revenue from it as they do GST revenue from it. So there's a hint in that when the ATO starts a GST review, you're basically lifting up the hood, and a lot of other issues get detected along the way, and a GST audit can very quickly spiral into a broader examination of a taxpayer's affairs more broadly. Superannuation guarantee is something we are hearing about a lot and seeing a lot, and there was a whole raft of cases around employees being underpaid their entitlements and so on and so forth, including by some prominent businesses and business people. That is all becoming very real, and the single touch payroll systems will allow for that even more, I think. And similarly, in the employment related issue, employment tax related issue space, payroll tax, which I've mentioned, and superannuation, with a particular focus on medical practices. And I will alert those of you who are in Queensland, or who have clients who are in Queensland, I will alert you to the now announced 6-month amnesty for the Queensland Revenue has announced for the medical and allied professionals and GPs, to sort of give them a chance to get their house in order from a payroll tax point of view. It's I think something that you should have some awareness about and communicate to your clients as necessary. And Hall & Wilcox will be publishing an article about that imminently, which you can look up and read. But as a bottom line final message, just remember that the revenue authorities are getting better at finding information, cross-matching information, and finding more and more, often in real time and often ahead of the game, when it comes to finding out what taxpayers are doing, and is very efficient in picking targets for review, and is focusing on particular areas where it's likely to find something to be interested in. So I'll wrap up with that final point, and then hand back so Bridget can close, and then we can give you some time for some questions.
Thanks, Frank. So we've just put up there some key takeaways based on what both Frank and I were speaking about today. I think what we're going to do now, given we've only got a couple of minutes left, Ketty, is that I think Ketty's going to come on and open the floor up to some questions if there are any.
Thanks, Bridget. And Frank, we did have one question that's come through the chat. So if an accountant provides standard disclaimer to seek legal advice and financial advice and make only comments and need to seek advice before acting, does that provide any protection?
Frank, I'm happy to take this one unless you had a burning desire. It definitely, it won't hurt to provide one of those standard disclaimers. So definitely put that in. But whether it will completely absolve you of liability will depend on whether, did you draw your client's attention to the actual disclaimer? Did you recommend that they obtain legal advice and financial advice, but then you still went on to provide advice which could be considered legal or financial? Or did you say to them, look, I recommend you get legal advice because this is complex, because it needs a qualified legal practitioner to provide this advice. I can't do it. I don't know the ramifications of, for example, whatever transaction we're doing in terms of the legal ramification. Did you say those things to them? Because whilst the disclaimer is great, if it's overridden by any statement or representation made later down the track, or immediately after you've given the disclaimer, those two things are going to be inconsistent, and that inconsistency won't help you.
I mean,
Do you have anything else to add, Frank?
No, just to reiterate what you said, Bridget, I think what probably happens a lot is that you might have a disclaimer that says that you won't give legal advice, but you do it anyway, and because oftentimes with tax advice, a legal question can't be divorced from the tax question. I mean, an example of that is if you have to make a decision about the year in which a CGT event has occurred. Now, to do that, oftentimes what you have to do is review a contract, the contract of sale, and make a determination of what was the point of contractual formation, which might be a not easy question. For example, if there are conditions precedent to formation or conditions precedent to completion, and you do need some legal skill, which not even I would possess, I think, if it was a pure contractual question, to make an interpretation like that. Another example in the duty area might be determining when the timing of a dutiable event or a transfer of dutiable property occurred. Again, to get the answer to the tax question, it depends on the answer to a contract question. So, I mean, that they can become very jumbled together, and they can become inextricably linked, the legal questions and the tax questions. And you might fall into that point, well, you think you've disclaimed it, but you've sort of done it anyway. So.
Thank you. I'll just add quickly, we do have a resource for members that does provide guidance when you can and can't provide advice if you are not licensed as a financial advisor. So if anyone's after that resource, reach out to publicpractice@cpaaustralia.com.au and we can put you in connection with that. And there's just been another comment from Mark in regards to basically accountants' letters and declarations, which is a really big hot topic amongst members at the moment. For those who may not have seen it, the 3 accounting bodies actually issued an accountant's letter toolkit last week, and that is available from the respective bodies' websites. It includes new guidance and templates in there. So if you're looking for support on that one, we've just got a new resource hot off the press. Look, it's been a really great webinar today. Lots of information and lots of great insights and tips and things that members really need to take into consideration. It is a tricky time at the moment, so really sincerely appreciate your guidance, Frank and Bridget. Thank you for joining us today, and thank you all members for sticking with us today through your lunch break. Really appreciate it, and I'll hand back over to Gabrielle.